Last week, over 4 trillion in market cap was wiped off the US markets in a matter of days. But what's next, and which is the black swan event markets might be ignoring? This comments on inflation, Trump's plan, and some lines on charts, of course, in this week's video. Let's start with the black swan event. So, to set the stage, I'll go over the end goal of Trump and the current tariff situation. So, China has retaliated with 34% in tariffs, and we are still expecting European Union's response to the 20% tariffs it got ahead with. So, what needs to be noted is that more and more countries, including the EU, China, Japan, and Korea, are starting to synchronize their response to the policy of the US president. Remember that the end goal for Trump is based on the views of his economic advisor Stephen Miran, who actually published his paper called A User's Guide to Restructuring the Global Trading System. So, in short, countries are divided into 3 categories: friendly, neutral, and hostile. And the US uses tariffs and its military dominance as leverage to pressure these countries to reduce their trade deficits with the United States. Another part of the strategy involves weakening the dollar to boost exports and revive manufacturing. So there is also a plan to reduce the cost of servicing the US debt. This is the important one. So most of the US administration uses the 10-year US Treasury yields as means to track progress on reducing the cost of debt. We are currently seeing something similar unfold. Large tariffs are being imposed, which even the administration itself views as leverage for negotiation. The dollar is falling, for example, has lost 10% versus the euro this year, and the important one, the 10-year Treasury, is massively down. Now, remember what I said, that more and more countries are synchronizing action versus the US. Well, the EU and China hold a lot of US Treasuries, and if this war continues to escalate, they might be able to weaponize them. So to understand how, you need to know that when the price of a bond goes up, the yield goes down, and vice versa. So if the EU and China start dumping US Treasuries, the price of the bond will go down and the yield will go up. And the cost of servicing the US debt, well, you guessed it, rise. Exactly what Trump does not want. Right now, this is not the base case, but it is definitely a black swan event to consider going forward, as if this happens, well, basically we're in for a ride. And speaking of going forward, we now have 3 scenarios. The first one is that Trump gives up on his tariffs as we approach the 9th of April. This is going to be very bullish and the markets will likely rip higher. Unfortunately, this is not like the likely case. The second one is the European Union, Japan, Canada, and India to start negotiating with Trump in order to get him to lower the tariffs. Right now, only India has shown some interest in doing this, in addition to South Africa. And if everyone chooses this path, markets are likely to start recovering. The third and worst, for now at least, scenario is that the European Union follows China into taking a more aggressive stance and imposes 10 to 20% tariffs on the US. This is rather likely, and if that's the end of the tit-for-tat tariffs, the markets are likely to move a bit lower and start consolidating. If, however, Trump decides to double down and increase tariffs even more, well, you can guess what happens. So another couple of very important data points will come on Thursday, as we see the CPI numbers for China as well as the PPI for China. The US inflation is also going to be published on Thursday, and it's a really important thing to note that this report will likely be of importance for the markets, as we get and if we get a lower number, we might see some sort of relief rally. But keep in mind that this CPI report will not take into effect the tariffs, which will start being priced in probably in June and July. The main reason for this is that most businesses have stockpiles for at least 4 to 6 weeks before they start importing the new and more expensive goods. So, to quote Jerome Powell's speech from Friday, the economic impact of tariffs may be greater than previously expected. He warned also that tariffs are likely to drive inflation higher, and this will happen in the coming quarters. And he also noted the potential for these tariffs to have a lasting impact on inflation trends. So, for now, these are the levels of support I have on my chart for the S&P 500. Scratch that. So, for now, these are the levels of support I have on my chart for the S&P 500, as we are likely to find some support between 5,000 and 5,100. If these levels are reached, we are likely to see Trump take some sort of action, well, hopefully, and he will mitigate the current sell-off. When, by the way, thank God we got some good numbers from the NFPs on Friday. It really would have been a disaster had they come lower than expected. And in addition to this, keep an eye on the Fed and what FOMC members will be saying throughout the week for some potential signs of intervention. Now, you're probably asking yourself what to do. Well, as I have been saying in the past couple of videos, have a watch list of stocks you want to buy and focus on relative strength. This means stocks that have dropped less than their peers, and just be careful with your risk management. Now, I forgot to note that we might be seeing another leg lower, but as uncertainty is extremely high at the moment. Anyway, it's time for some more lines on charts. So I want to bring to your attention gold, which actually blasted through last week's target of 31.20 and is now down almost to the 3k support. This is $3,000 per ounce, and this level is likely to attract bulls, but be careful, because even if the path of least resistance is up, there is still a lot of volatility in the market. The other one is the euro dollar, which has made a textbook breach higher. The drop you are seeing here is mainly due to the aggressive move higher, and we actually have not seen such a move in a while. Bias still remains bullish, but Trump-induced volatility is likely to remain high, so definitely keep risk in check. The dollar yen also continues to move lower. The main reason, in addition to the weak dollar, is that the yen is traditionally a safe haven asset, and not an asset but a currency anyway, which appreciates in times of turmoil. Now, when the risk is coming from the US, traders are turning towards the yen and of course the franc, which is and has always been another safe haven currency. And in addition to the tariff and trade war news, keep an eye on the Eurozone retail sales and the US 3 and 6 month bill auctions on Monday. Tuesday is rather lacking with a couple of ECB and BOE speeches. Wednesday is the day Trump's tariffs take effect, so definitely keep that in mind when trading. And also note that the National Bank of New Zealand will also announce interest rates. Another risk event will be the FOMC minutes. So basically Wednesday is going to be very volatile. We also have the initial jobless claims on Thursday. Watch out for a slowing jobs market, which will send equities down. So know that for now, good news is good for the market and bad news is, well, bad news for the market. Friday has German CPI, which is likely to stir up volatility. And basically that's it for this video. Hope you enjoyed it. So if you did, feel free to subscribe and leave a like, and thank you for watching.